Hello and welcome to the ICC Livecast, a new podcast series where we take a deeper dive into global business trends and ideas. I'm your host, Thomas Paris, and today I'm joined by two very special guests, John Bugeja and Lionel Taylor, Managing Directors at the Trade Advisory Network. So a few notes before we get started. This is a pre-recorded episode, which means there will not be a live chat component. Our guests both came through Singapore to co-host our 8th annual Supply Chain Finance Summit, and I couldn't pass on the opportunity to sit down with both of them. However, we will be hosting live broadcasts every month throughout 2019. So if you're listening, remember to sign up on our website. Registration is free, and signing up will give you the ability to watch us live and participate with your own questions. In this episode, we will discuss the impact of the cloud and infrastructure decentralization in today's supply chains, how major players have adapted to these trends, and what to expect from the biggest disruptors looming over the horizon. John, Lionel, thank you so much for joining me today. Let's kick things off with a glimpse of your work at the Trade Advisory Network.
Okay, shall I kick off with that? So Trade Advisory Network, Lionel and I started just over 3 years ago, having worked together within our separate consulting businesses for 3 years prior to that. And we both have a banking and invoice finance background, so we've been involved in trade and supply chain finance for a very, very long time. And we decided to set up Trade Advisory Network to really continue our involvement in the business, but not constrained by being in a large bank. So now we work with banks, fintechs, technology service providers, corporates, and educational institutions such as the ICC Academy. We do advisory work and also write training programs and deliver training face-to-face and online. And that's one of the things we're doing with the ICC Academy is working on training. And we're going to be heavily involved in the ICC Supply Chain Finance Summit over the next 2 days, which is why we're here in Singapore.
Well, thanks for that, John. We're really pleased to have you in Singapore this week. And for those who couldn't make it to the summit, we will be recording all of our video panels. Now, your role in training different major players has given you an inside perspective at different stakeholders of a global supply chain. How has this experience colored what you believe goes into properly adapting your business to technological trends?
Yeah, kick off on that.
It's interesting because when we talk about major players and we look at the major players in the supply chain, we begin with the buyer and the seller, the buyers and the sellers, and then we have not just banks, we have insurers, we have logistics, a whole multitude of services into that supply chain. And often as banks and as bankers and as funders, we always think that we're actually the pivotal part of it, but we're generally not. And invariably, a lot of the changes that have been happening over the years have been around the physical supply chain.
Right. And
there's a lot of talk in terms of, just-in-time deliveries in the auto manufacturing and other type of sectors. Nobody wants to carry inventory, so what have you. And invariably, the financial supply chain, which is really the financial consequences and the financial documentation that follows the physical movement of goods, is really becoming a new area for technology. And this is where we're seeing the digitization. This is where we're seeing a lot of consortiums springing up of collaborations between banks, sometimes banks with technology companies, banks with freight forwarders and technology companies, starting to look at that physical supply chain and then saying, so how do we adapt things around the financing supply chain and there's a collection of data in a digital manner? And there's a lot of movement, there's a lot of change in an industry that traditionally had very little change. So in terms of how they're adapting today, I think there's a lot of interest because all of us in this industry are great enthusiasts, and that interest is moving forward into a lot of proof of concepts. Can we have an LC type structure through a blockchain with a smart contract. There's lots of proof of concepts. There's lots of discussion. I think in terms of the banks, I think the major banks, and where you've got very, very strong teams and organisation in place in terms of trade or supply chain, very much at the forefront. And they're very involved in trying to ensure that technology and that advancement suits their model. They're also looking at their capabilities in-house, saying that once that technology comes through to an industrialization element, so we want to industrialize it now and adapt it, we have the capabilities in-house to really build on our delivery and our efficiencies and possibly on new solutions. I think for other banks who maybe are not as strong, they're sort of followers in the process, but they don't yet have the thought around the strategy, around the capability and capacity building within their organizations. So they might have the technology available, but technology doesn't provide you with new customers or the servicing of existing customers.
And it's worth just taking a step back and reflecting on the environment in which this technology is being deployed or potentially being deployed. International trade is a very exciting activity, but it's not without its challenges. So everything takes longer when goods go across border, especially as most goods still go by sea. Now, there are some goods, high value, low unit weight, like low mass goods will go by air if they're urgent and so on. But the vast majority of goods traded internationally are going to go by sea. That takes a long time. There's the costs associated with the logistics of transport by sea, which means that it's not cost effective to do it in small lots. So you end up with large consignments rather than small. Large consignments mean large inventories, means longer lead times, longer manufacturing periods. All of that adds complexity to the process, adds risk to the process, because it goes wrong in a bigger way. You've got different legal systems, jurisdictions, accounting practices and so on in different countries. So those are all challenges faced by companies that trade internationally. But there's pressure on working capital. Ultimately, all of this translates into a need for greater working capital support because you've got larger consignments, longer transit times and so on, as I mentioned before. So international trade is very important, but quite complex. The processes around international trade, before you get into the banking, are also quite paper intensive. Historically, there's lots of customs declarations, there's lots of license issues, there's inspection issues, there's certificate of origin issues, lots of things. And traditionally, that was all paper. Whenever you have paper in the system, you have the risk of delay because the paper can sometimes move more slowly than the goods. Right. Even if the goods are taking quite long to get from A to B, right, the paper can actually get delayed further. Then there are mistakes. Lots of people typing information onto bits of paper historically. Little mistakes mean you start from scratch. So before you get into the world of banking and finance and insurance, you've got a paper-based process which is inefficient, costly, and prone to error, which causes delays, which has a knock-on effect on the financials of the companies involved. So there's an incentive on behalf of those parties that are involved in physical trade, which is the buyer and the seller and the carrier and all the other logistics providers, saying if we reduce the paper, we can improve the efficiency. So they've got an agenda, which is let's try and make things slicker. So some of the work done by the customs authorities in certain markets, particularly here in Southeast Asia, for example, is aimed at making things smoother, right? Eliminating the friction in the process, but by making it data-driven rather than paper-driven. So this is happening, irrespective of what's happening in the banking world. They didn't think we must digitize the trade processes in order to make it easier for banks to finance us. That wasn't the thought process. On the other side of the fence, you have the banks, who are also historically buried in paper whenever they get involved in trade. And this is an expensive process, which is error-prone. So the banks also have a thought, which is, wouldn't it be nice if we could streamline this and make it easier? But we still actually want the control and the visibility that the traditional trade solutions give us. Otherwise, we have a problem with the risk. Right. So they sort of want different things. The two sides of this business, the physical and the financial, are beginning to come together now. Not necessarily with the same objectives, the same agendas, but they are beginning to interact. So we're now beginning to see a process whereby the work done on the banking side to improve efficiency of financial solutions is now trying to marry the work done on the physical side, which is trying to improve the efficiency of the physical goods movement and processes associated with that. All of which is great, but it doesn't necessarily, it's not necessarily a big step change. It's an improvement, potentially, in the efficiency and the cost effectiveness of what happens in the old paper world. Mm-hmm. Is it actually addressing a core underlying problem? Big question. So if we think that a core underlying problem, according to the research, the ICC research, amongst others, is that SMEs, particularly in emerging markets, struggle to access finance, is improving the cost efficiency of the process going to materially change that? The answer is probably no. So there's got to be some other use of this technology and the advances in technology which allows a greater availability of finance to parts of the economy, particularly the SMEs, particularly in emerging markets, that don't currently have access. Mm-hmm. So that's a sort of a higher level objective, which everyone talks about and is aware of, but so far the progress towards digitalization has not really touched that. It's really focused on the efficiency gains. It's a good first step, but it is only a first step, and it's not really revolutionary. It's just a little bit better than paper. So I think there's a long way to go, and there's a lot of interaction, a lot of collaboration necessary between all these stakeholders, and that's going to be one of the challenges: collaboration across different industries. You can't have 150 different ways of issuing a conditional payment undertaking in the digital world, because a company can't cope with that. A company that trades internationally and has lots of different bank relationships, they can't have lots of different ways of doing the same thing. There's got to be some standardization at some point.
Right.
And that's, I think, where we're now heading in the digitalization process.
Right. To make the generational leap that you're talking about, these puzzle pieces have to fit into place elegantly to be successful in the long term. But which industries do you believe will be the slowest to adapt?
Yes, we might have different answers.
I was going to say that. I'll start with my view. I think it's the funders, whether that's banks and to an extent non-banks. I think the role of non-banks and fintechs is important too. I think the banks generally will be the slowest and have the most challenges. Because the decision-making process in a bank to either extend a solution, i.e. to have more credit capacity, or not just extend that solution, but maybe create a new solution, requires a whole approval process. Some call it a new product approval process. But it often then involves other stakeholders within the bank. And when you have legal, compliance, credit, sometimes accounting, they have generally different agendas. So the business heads, and both John and I have been business heads in the banks, all very excited because we get it. This is our world, our business. It doesn't necessarily translate to a credit or compliance area agreeing we're going to write a new policy to support this innovation. And I think to an extent that will create more challenge, whereas a freight forwarder and others involved in the supply chain, the digitization, this is their business. This is about the marrying of that physical and financial element. It's their business around documents, and for them the efficiency gains and the visibility gains are very, very quick. For the bank to then suddenly say, well, I can benefit from that, and now I'm going to do some new stuff. It's going to take time.
Right.
And if you're in markets, and we know in some of the markets in Africa and certainly in Southeast Asia, the banks are reticent, about funding against, I think what IFC calls movable assets. How do I provide finance against a receivable? How do I provide finance against inventory? I prefer something like a building that's solid, it's there. I know how to make a loan against something like that. How do I register my interest in this other asset that changes, it moves? do I have the legal infrastructure in place within my country to register my interest so that everyone else can see, I've got an interest in those goods, or I've got an interest in that receivable. And then if I have an interest, how do I then control and monitor it so that I feel safe as a lender? Now those things, there's a whole multitude of things that have to happen,
Right.
both internally in the organisation and externally in a sort of country regulatory way. So for me, it's a fine that the funders.
Yeah, and actually, I agree with that. I think the irony is that not only are the funders, not only is it difficult for the banks, in particular the large bureaucratic banks, it's very, very difficult for them to innovate in that way because of the other stakeholders involved. Credit being incredibly important, compliance, operations as well. There are lots of people who need to sign off on any new solution. And they want evidence of how it's going to work. What happens when it goes wrong? What's my remedy? And if it's a genuinely new solution, as opposed to the digitalization of an existing product, which is slightly different, somewhat easier, then the answer is, well, we don't really know. And therefore it's really difficult to get traction. But at the same time as being in that position where they are the huge tanker that is difficult to change course, they also think they're in charge. So, and having been in the banks, both of us for many years, we sort of know what that feels like. You sort of your starting point is, we do trade finance, we do supply chain finance. So we've got a new capability. We want all our customers to adopt our model. And yes, it'll benefit them, it'll be really efficient and slick, but it's our model. And it's not the same as the bank next door's model. We use different technology, different protocols, different front-end systems. And this started with electronic banking, many years ago. Each bank had its own proprietary systems and did not want to collaborate. In trade, for the smaller customers, that's still the case. But for the larger customers, they basically also turn around to the banks and say, no, we've got 30 bank relationships. I'm a big commodities trader. I am not going to have 30 systems to administer and log into and manage and have none of the data resulting from those transactions consolidating in one place. We'll have one system, and you guys in the banking world will either collaborate or you're not on our panel. So we've already seen that transition for the larger corporates in traditional trade finance. And I think we'll see the same thing. The banks have to recognize, and I think they do, but they don't necessarily know how to deal with this recognition, that the underlying transaction is actually what drives everything. And the underlying transaction is owned by the buyer and the seller. They drive it. They are the primary parties or the principal parties in the transaction. The next most important party in the transaction is probably the carrier, because the goods have got to get from A to B in order for the contract to be executed. After that, everyone has their place in the hierarchy of importance. And the funders is there. It depends on how liquid the companies are as to whether they're towards the top of that list of important but not crucial stakeholders, or at the bottom of the list. It really does depend on their own liquidity and their own power in the supply chain. So the carriers, in many ways, carry a greater responsibility and a greater leverage in saying, we want to do it this way. And we do want to collaborate. Now, we've seen a number of technology providers now actually coming up with platforms whose purpose is to take data from the different stakeholders in different formats and then create not a marketplace in the sense of an auction, but create a marketplace where all of the stakeholders can access and see the data. So what they then do with it to drive transactions is for them to sort out inside the organization. So hence earlier comments about credit, legal, account, compliance and so on. But at least the data should not be the obstacle. Technology should not be the problem. It's easy for us to say that because we don't sell technology. But yeah, it really shouldn't be the problem. It's what the banks then do with that information to create propositions that's going to be the big challenge.
I was going to add one thing around the non-banks, because there is an explosion of non-bank activity which began after the financial crisis, where the first pitch of the non-bank was very much based on, your banks do this and that, we are much more flexible, we can come in, we will be quicker and more nimble, and we will provide you with exactly what you want. and not take, every aspect of security that the banks would take. And there was an argument at one stage around that. I mean, but what we've seen in practice is, yes, you have the non-banks, whether they're called alternative funders or fintechs, coming into the SME space, and looking at those spaces and saying, okay, we have now a proposition, often similar to those that the banks actually offer. But their view is, we can do it more using technology. We don't have to talk to you. We can do it all online. It might be a marketplace and what have you. And what we're seeing is, whilst they're they're very much adopting technology, often driving it, they're finding it very, very difficult to scale as a business.
Right.
Because, first of all, their own funding is more expensive.
Right.
And therefore, that expense, and it might be backed by credit insurance or some other risk mitigant, means that the customer is having to pay more. If you're an SME and your margins are not that great, suddenly having to pay double what a bank would charge you if a bank were to offer the solution is a bit difficult to take. Also, generally, no matter what the view has been around the banks and their conduct in the financial crisis, generally we trust our banks. If we are depositing money or we are looking for a facility, we tend to feel that the banks are more stable, more secure. That's the tradition and history. So to an extent, the non-banks often lead the way, but very rarely does anything take hold until a bank actually says, I'm now going to do that. And when the banks get involved, the non-banks have very little chance to compete.
Right.
And so what we're seeing is a multitude of very exciting innovations, often so-called marketplace-driven fintechs. But the truth is, are they really able currently to scale as businesses? And I think at the moment, a lot of them are finding that difficult.
And in the context of cross-border trade, which is sort of the main area of opportunity and challenge, domestic trade is important as well, but cross-border trade is more complicated. It's difficult to get on both ends of a transaction if you're only located in one place.
Right.
By definition, cross-border trade involves two different countries, separated by some distance and probably cultural and language challenges as well. So a fintech operating in one location, no matter how digital they are, is quite an investment for them to get a level of understanding of the legal jurisdiction in multiple countries when they're not present in those markets. They don't have a history of partnerships, which the banks do. So the banks have that advantage. A small number of banks are global, a smaller number than they used to be, and even the global ones are not as global as they used to be. So global banking is not really prevalent anymore. But partnerships or correspondent relationships are that's the history of banking and trade. That's how it all started. And those partnerships still do exist, slimmed down a lot because of the compliance costs, amongst other things. But certainly that's one of the reasons. But fintechs, that's not where they're starting from. They don't have that history.
Right.
So they have to think of other ways of financing international trade. And it's probably one of the reasons why most fintechs that actually facilitate financing as opposed to work with the banks actually tend to focus more on domestic trade, which is inherently easier. And they tend to focus on invoices because an invoice has a standing in legal terms in the markets in which they operate. I'm not saying it's easy, but that's at the easiest end of the scale of the problems you're trying to solve with technology. Cross-border stuff is more difficult.
Right. And
we haven't seen that much progress of fintechs that fund transactions. We've seen progress in tech, of consortia being formed, and platforms being created which the banks can use, which facilitate cross-border transactions. That's slightly different.
Fintechs today are facing a wall built up by traditional banks, but it seems like this is just a matter of time. From your perspective, what does the timeline look like for these banks to catch up in this category?
I think optimistically, 5 to 10 years from now, we should see some major change. But I don't think it's a given. I don't think it's certain that will be the pace, because it depends what the other priorities are that the banks are facing. This is just one area in which they can spend their investment cash. And if all banks are constrained, they have to make decisions. They might have 100 projects, all of which pass the test, the internal test in terms of return on investment and payback dates and all of those sorts of things. They're great, but they can only afford to do 10. So they'll pick the 10 that are most important, most urgent. The top ones that they do pick will probably be the ones, first of all, focused on keeping the bank in business, avoiding getting fined and avoiding people going to jail. Right. So compliance, in other words. So if there are lots of initiatives and lots of things which are focused in that direction, that will delay this sort of investment. However, if this sort of investment actually has a material benefit in terms of compliance, which it ought to, because you've got better quality data, an audit trail, you've got more visibility and more control, that could actually accelerate the adoption. And the challenge will be prioritization, but also credit. As Lionel said, if it's just about cost saving, it's quite difficult to make the case in the short term because you can't decommission existing infrastructure. When you invest in the new solutions, new technology, you run in parallel and your costs actually go up for a while. And until there's been a wholesale migration from the legacy solutions to the new solutions, you can't save money by decommissioning. So that'll cause a lot of banks to sit back and watch and say, well, let's just learn from everyone else's mistakes. And when it's clear what everyone's going for, then we'll jump on the bandwagon and then we'll benefit without having taken the pain. That tends to slow things down somewhat.
Funny enough, I actually agree in terms of timescale. I mean, we did have this discussion before we came in the room, by the way. But we sort of agreed that it's going to take longer to see what I call the sort of industrialization and how these translate into the solutions, and not just the delivery of existing solutions, but the development of new or extended solutions. I think that allied to that, there is always also a challenge, which I mentioned at the beginning of the discussion, that you as a business can go one way, but actually at the end of the day you have customers. And it's always about translating what you find exciting and innovative and within the world of trade and supply chain, and how relevant is it to the customer. Well, that will vary depending on the segment. Banks generally, especially the larger banks, are very, very good at developing the solutions and the platforms to cater for the needs of the major corporates. Major corporates always say that the banks are not that, but invariably my experience has been that the banks are very good at that side of things. Not so good as you move down the chain, into the mid-markets, to the smaller, the SMEs, and even the micro businesses. And sometimes you'll see developments in a bank, and then you say, well, are your customers really benefiting? And this is a question that we're often asking now to some of the banks that we're speaking to globally, who are not the global banks, but they're maybe the regional banks or the local banks, and they're talking with us about, we're looking at this technology. What's your view? Can you give us some market insight? And often we go back and say, let's talk about your customers. And what are you trying to, what are your customers asking? What are they saying? And then you've got to take that need and then put that into your solution. And, so sometimes I think that often the technology is coming before the discussion with customers. So I think that has to happen. And I don't think it's necessarily happening today.
Yeah, I think the what's changing outside of the world of banking is going to probably be a bigger influence on this rate of take-up. So I remember many years ago when I thought I had a product, and I thought I had the most wonderful proposition. And the chair of the investment committee basically said, "I'm not interested in your opinion." By which he meant, you show me a line of customers that are going to pay for this and I might give you some money. And of course with innovation, that's really difficult. But the customer driver is nevertheless the important one. It's really difficult to get. But if you think about what's happening in the physical supply chain and what could be happening, these things might actually influence the pace of development of solutions more quickly than any of the other things we talked about that are happening within the banks. So, for example, we've got protectionism in international trade. Mm-hmm. We've got free trade agreements being negotiated or being abandoned, depending on which way you look at it. We've got sustainability. We've got, as an issue, which quite rightly, we've got ethical policies, quite sensible. Health and safety issues. Mm-hmm. There's all sorts of reasons why in the physical world, the way supply chains look and work might change beyond recognition in the next 5 years. Quite possible. Technology itself might even promote that. Let's say, for example, 3D printing becomes so all-consuming and so prevalent that the concept of shipping stuff from A to B becomes a bit old-fashioned. Right. So we're not quite in the realms of Star Trek and the machine that you stand underneath and you disappear, the transporter, you turn up somewhere else instead. I'm not suggesting that's going to happen anytime soon. But 3D printing is actually, in many ways similar. You don't actually ship the goods. You sell a license or you grant a license to the licensee, and they have so many applications of that model, that pattern on their printer. The printer's still got to be shipped there, obviously, but the components that the printer then makes are made locally. So there's no shipping. So it's a different trade model at that point. It's data. That's all that's being transferred from party A to party B. That's where the value is. That'll change the way things work. Now, that's a bit extreme, admittedly. I don't think we're going to see 3D printing take over the world just yet. Just could do. Right. In the future. 5 years, a lot of things will change in terms of technology. Mm-hmm. But if you just focus on the protectionism and the sustainability issues, the environmental issues, what's that likely to do? It's probably going to reverse globalization in a sense. So the trend towards globalization was pretty much one-way traffic from the 60s mm-hmm. until maybe 2-3 years ago, and the crisis obviously didn't help in that. But now, I think what we are beginning to see, is companies thinking, well, I don't want to ship stuff all over the world. I can get it produced closer to my market because it's no longer a labor-based production process. It's a technology-based production process. So different costs of labor in different economies cease to be the driving factor, the determining factor. And the cost of freight now and the time taken to ship goods from A to B mm-hmm. is now becoming more of an issue, particularly when you factor in the sustainability issues. Maybe I should move my production closer to my markets. So you end up with more regional hubs rather than global supply chains. So when that happens, the need for finance will change. The technology will be probably more data-driven than mm-hmm. paper-driven, because there will be new supply chains, as opposed to the older supply chains updating themselves. These will be new supply chains, so they're probably going to be using new technology from day one. And I suspect that when that happens, the demand from the customers to the banks and maybe to the carriers, and from the carriers to the banks as well, will be, look, this is the way we want to do it. Mm-hmm. We ain't going to use your old-fashioned instruments anymore. So if you want to stay in the game, you need to work by our rules, because this is how we want to play. So it'll take the major corporates, who are the anchor parties, if you like, in the big supply chains, who may be right at the end of the supply chain, they may be in the middle of the supply chain, but they are the most powerful party in the supply chain. It may well be them that dictate the pace of change by saying to the banks, this is how it's going to be. And either you're in the game or you're not in the game. And because the technology facilitates access to finance through other routes, mm-hmm. Because there's quite a lot of liquidity around mm-hmm. At the moment, and it does vary, obviously, with its cycles. But it's a question of how does the technology facilitate mobilizing that liquidity to meet that particular funding need. The banks are not the only game in town. And I think over the next 5 years, we may see more pressure from the corporates to say to the banks, this is what you need to do. Otherwise, we're going to disintermediate you. And that'll certainly get their attention.
This is interesting. So from what I understand, the through line of the conversation really centers around the access to data. For the general public, we're still broadening our concept of data transparency and the impacts it can have on advertising and privacy. While the businesses focus on organizing their data collection to improve value and productivity, specifically on the business side though, data-driven solutions like blockchain will directly affect how we conduct trade and structure our supply chains going forward. How are you expecting this to level out?
Big data and the Internet of Things
Yes.
and artificial intelligence and machine learning all sort of go together in some ways. The big data on its own can be used as a marketing tool and is used as a marketing tool, particularly at the retail, the personal customer end. There's some people are really uncomfortable with that because their data is being used to target stuff at them. Some people really don't like that. So that make it regulated beyond belief that over the coming years you don't really know.
Right.
But if you sort of look at it more positively and say, well, there's a lot of information out there about what customers want and need and when they want it, link it to the Internet of Things, which is already the case in supply chains anyway, with just-in-time delivery. And there's the auto industry, for example. The car manufacturers really don't hold stock of hardly anything. Stuff arrives on the production line about 2 minutes before the robots connect it to the chassis that's the car body that's moving from along the production line. They don't generally hold a warehouse for all this stuff. It arrives just when it's needed, and that's all driven by the data coupled with the data analytics and the supply chain management processes. So I think we'll see more of that. So it's a combination of all those things, I think, which will change the way people buy and sell things. And data, it becomes incredibly valuable. So it needs to be managed. It probably will be regulated to a greater extent. It is already regulated to a large degree. But how it's bought and sold, it becomes a commodity. It becomes something which has a value in and of itself, increasingly. And I think that will change some behaviours going forward.
And I agree with all of that. I think the integrity around the use of the data is a challenge that we're starting to see in the world, and the discussions around Facebook and others that have large amounts of data and how they've used that data, Google as well, are becoming issues which I think governments and regulators are struggling to work out. How do you control and manage this? And a lot of, what we see, when we see in commercial banking is things start in the retail, personal banking, and it moves into commercial. We're now seeing a lot of discussion around our personal data, how it's being used, and questions and, from government levels, etc. And that will permeate through into the commercial side. And as John mentioned, I think the use of data to predict the behaviour, whether it's us as individuals or us as companies, actually can be a very positive thing. But it is deemed to be intrusive. And again, there's a cultural aspect. I know from experience in Asia that, people don't necessarily want to share their data or have their data shared, whereas people in the West might be a bit more open to it. So there are cultural elements, I think, that come into it. I think an area of potential negativity for me is the use of AI in basically taking away the human element of understanding what's happening in a business. So we are seeing more credit models being built using algorithms, and again in the personal or the personal markets, we're seeing this often with mortgage lending, that the computer says no, but actually there's a story behind it. There's been some highlighted cases in the newspapers where a family have basically decided to move. So, the old mortgage is repaid and they need a new mortgage for the new property, which is less than the old mortgage, but the bank is saying you can't afford it. Yet they were happily paying for 15 years the old mortgage, but the computer program, and the algorithms have combined and said you can't afford it.
Mm-hmm.
In terms of, as John mentioned, overseas trade and, even domestic trade, when a company is looking for working capital, it's not just about a balance sheet. It is about their trade cycle. It is about understanding the cash flow gaps, etc., the story. And my belief is that if we go too far one way, we lose the story.
Mm-hmm.
And therefore, companies might find it more difficult to access the working capital that they could previously access because the computer says no.
Mm-hmm.
And the banks or whoever, the lenders, move away from this idea of saying we can have some intervention that can now take over and say we'll do some manual underwriting, we'll understand the story, and therefore it doesn't matter what the computer says, we think this is a good funding proposition. So I think that there are a lot of positives, right, but there are some warning signs. Yeah.
But don't you think that this is symptomatic of a sort of teething process for AI? By that I mean that not every variable has yet been taken into account, but by its own definition, it's learning over time.
I think AI sometimes can mean artificial ignorance. It's not necessarily that intelligent. But yes, I mean there is an element of learning on the job. I think it's not so much the technology; it's the businesses that are using the technology. They need to use it the right way. They need. If you don't ask the right questions, it doesn't matter how clever your system is, you're not going to get the right outcomes.
Right.
So could AI develop further so that it does capture more data elements so that it makes better decisions? Yes, probably. Will it ever capture an understanding of a process which is changing? I don't know. It's difficult to say. Right. But if you just go back to today's reality and the world of trade finance, traditional trade finance has been with us hundreds of years. Trade finance is all about knowing what the cash is being used for, knowing when it should come back to repay, the source of repayment, and having visibility and control en route, and maybe having a control of the goods if there are physical goods involved. That's all it is. It's not that complicated.
Mm-hmm.
Is it possible to digitize all of that using all of this technology, all the buzzwords that we've been using? It ought to be possible for artificial intelligence to support those decisions. And if we take an example, we do work with the automotive industry, for example, on our corporate side of the business, and you get to learn about the physical supply chain in a very real way when you actually talk to an engineering company that's in the physical supply chain dealing with car manufacturers. Mm-hmm. And one of the things that we've understood from working with these people is the way inventory is tracked. And there's a reason why this is important to a bank, which I'll come on to in a second. But it's interesting that everything is barcoded. So when inventory moves out of the warehouse and is taken up by the buyer or goes into the manufacturing process, goes onto the production line, the ERP system knows because it's been barcoded as it goes through. So they know where the inventory is. They know what the status of that inventory is. Is it in the middle of the production process? Is it finished, part of the finished product, or is it in its raw state, just a single component? Now, given that happens in the physical world today, let's go back to what do trade financiers like. Mm-hmm. They like to know where the goods are. The goods may be charged to them. They may have a security interest in the goods. They might want to know that those goods will only be disposed of in accordance with their instructions. All of that data already exists today in not every industry, obviously, but in many industries, a lot of that stuff already exists. So could we use the data, the Internet of Things, artificial intelligence to drive a financing solution which makes a bank more comfortable with inventory as security for an advance, for a trade finance facility or a supply chain finance facility? I think the answer probably is yes, we could. We could envisage that. We could probably write a paper now, an entirely conceptual, theoretical paper on what the banks should do. Will the banks do that? Probably not anytime soon. But maybe the disruptor will come from another part of the financial world, which basically recognizes this, takes the knowledge of how trade finance works. How do banks get comfortable with trade finance facilities today? And they say, maybe using this data and this artificial intelligence and these processes, we can actually get comfortable with a higher level of exposure. Our risk appetite will go up, and we can now start to support companies that couldn't be supported before. Their balance sheets are rubbish, so we can't do that. But we can control the transaction flow, and we can control the cash flow. Therefore, we're comfortable. And maybe it'll be a challenger bank. Maybe it'll be a non-bank. Maybe it'll be a major corporate that says, nobody's doing this. Our supply chain is suffering. We'll do it. Who knows where that disruption is going to come from. But that may be where some of this technology ends up getting used. And the banks will then quickly jump on the bandwagon, I think, at that point and say, yeah, we're going to do this. Yeah, look at how much we're doing.
I think you've hit on my view, what I believe is going to be a big opportunity. Because I think, and we're generalizing, but I think, the banks are going to become more standardized and are becoming more standardized in their approach currently. And the way in which, as I mentioned, around the automated credit models, etc., just add to that standardization. So that does create the opportunity for the lending institution, whether it might be a bank or a non-bank, whatever, to say, well, actually, my approach is different. Yes, I could use all this technology to support me in my credit decision, but actually I want to get the story. I want to still have that human interface. But actually then I will use that technology in terms of my transactional control and my monitoring. So my decision is still based on understanding the story, understanding the business that I'm looking at. But I'm aided by the technology in terms of the monitoring and the control. And I think that, in my personal view, is where there is some great opportunity going forward. What I find disappointing currently is a lot of the new banks, the challenger banks that we come across, are really replicas of the banks that the people that set it up came from. And the way they're talking in terms of differentiating themselves is, we're smaller and we're nicer. But the truth is, they're not actually offering anything necessarily different to what they're...
There are one or two challenger banks in the retail space that are materially different, but not in retail. But there are some real radically different models out there, which are getting good traction. Really innovative approaches, but we're not really seeing that in the corporate space. So they are like miniature versions of the establishment. I think that's a challenge. It's an opportunity. But as Lionel said, you can really see, if you think about what digitization and machine learning, artificial intelligence, and the use of data, what all those things could be used for, control is actually, you don't have to make judgments so much about what a company is going to do and whether it's going to be successful or whether you think the management is competent or not. It's difficult for somebody that's not actually a human being standing in front of the customer to make those judgments. They can make those judgments supported by data analytics. Obviously, that helps enormously. But ultimately, a human being is probably best placed to make those judgments. When it comes to controlling a transaction or the flow of transactions, once you've decided what the lending parameters are and all this data is available, that actually, humans are pretty rubbish at that. They're error prone. The automation that a human being would recognize to control transactions usually looks a bit like a spreadsheet, or in fact is a spreadsheet, or multiple spreadsheets that don't talk to each other. So that's a huge opportunity, and I think moving the focus maybe to transactional control in order to increase risk appetite. It's not for its own sake. It's not to become even more conservative. It's to say, well, we can now get more comfortable. because we can control all the moving parts, which improve the probability of getting repaid, I should say, and also give us early warning of something that doesn't work exactly as it was expected. If it's a change, something didn't happen that it should have done, or did happen when it shouldn't, quickly, alarm bell rings, let's quickly examine it and take appropriate action. I think that's a huge opportunity for the use of this sort of data.
And will increase. I mean, and I saw this within the factoring industry that I originally grew up in, is that invariably, as a factor, you're looking at clients and you're looking at trends around the receivable. And things jump out at you. The invoice is 3 times as large as it used to, or normally is, or there's some anomaly around the payments, the way that the customers are paying, or they've missed out a whole bunch and stuff. In the past, you had the human element looking at that because the technology wasn't there. Then the technology was developed, and the warning lights will come on automatically. Now, yes, that translated for the lenders into we have a more controlled book, but the consequence of having a more controlled book was that the appetite to do more business increased because we knew we could control it, and dare I say, our shareholders, our investors, would say that we have more. We see what you're doing. We have more faith that you guys can run that business and grow that business. So, I think the consequence of better control is actually I can do more business.
Yeah, absolutely. And it's not easy to convince the investors that the better control will result in risk mitigation. Therefore, we should do more business because until you've done it, you can't prove it.
Right.
It's a slight act of faith, and probably more importantly, the regulators. The regulators don't believe it until it's been done. Show me 5 years track record where, as a result of better control, your impairment rates are improved, and then we maybe will loosen up some of the capital requirements to allow you to do more business. They've got to be on board with the whole concept. Otherwise, the capital constraints are still going to kick in. Credit folks in the bank, they've got a very important role to play. But again, they don't immediately roll over and say, right, now you explained it to me. Of course, we'll change our credit policy, or we'll apply our credit policy in a much more liberal way because you've explained it to me. They're still going to turn around and say, we need some evidence this actually works. So it's not going to be as quick, as we'd all like. But I think that's the big opportunity, and that's the direction of travel.
Fantastic. Well, this has been a very interesting hour. As a bit of an end cap, I have a broader question for you. If we take a look at the last decade and rounding up from 2010 to 2020, what do you think has been the biggest technological disruptor, specifically in the area of trade and supply chains?
The mobile phone.
Mobile phone?
Yeah, probably. I mean, it's
fair enough.
Yeah, that's probably it. It's a good example of a major disruption to not mobile technology, not necessarily, but mobile technology generally.
Right.
And the new industries that have sprung up on the back of that, and the new things which we all now take for granted, and we get impatient if we wait 20 seconds for something to load. I want to watch a film, I watch it now. I want to buy my goods, I want them delivered this afternoon. Before, you'd go to the store and they say, yes, you can have that, we'll take a deposit, we'll let you know when it's in, could be 3 months.
And now you can track them on a map.
And you can track them, absolutely, yeah. When the delivery man is in the area, you get a little warning.
Right.
And these things have changed. And we might not be seeing the impact of this in the macro world of trade and supply chain finance yet. But I think over the last 10, 15 years, if you look back at what's changed, that's probably the biggest change, which we all take for granted now. We don't even think about it.
Right.
When we get our airline tickets, we don't bother printing them out. We just, you phone and you do whatever you do. I think that's a big change. I know you were going to say that as well.
I know you should do it first. I mean, absolutely. And I think I like too that I think the biggest change is in the next generation. entrepreneurs and what they're used to seeing. And as John mentioned before, instant decisions. I had the situation last night. My daughter basically told me she'd run out of money yet again. And I'm here, and she wanted some money to go and do some food shopping. And I opened my iPad, I went on the banking app, and I transferred some money to her. And she said, "Thanks, Dad, I can see it." My account. Instant. Right. Now, I sit back and I think, wow, I couldn't have done that 10 years ago. Yeah. She sits back and goes, that's what I expect. Mm-hmm. And I think the expectation is everything more instant. We can't say that the technology does not exist to be able to do things because we're seeing it on our personal and our private lives. So if we're seeing it then, why can't we see it in our business and our commercial lives? And for me, I think absolutely mobile technology, especially in some of the markets. We look at some of the markets in Africa, which are now more advanced in payments than some of the established markets because they've gone straight and leapfrogged into using mobile technology. I think even now the way in the trade and supply chain world, there was, I remember the initial discussions around cloud. We'd never ever allow, never ever would we get our compliance or regulators to agree to that. Now, in some areas of the world, there are still questions around where the data is being held. I think in some markets, the regulator says, well, I'm very happy with cloud as long as the data is within my jurisdiction. No. But actually what cloud has done is given access to the latest platforms, the latest technology at a much lower cost. So the barriers to entry and barriers to market have been totally reduced. Big change, not as big as mobile in my view, but a big change. We're now seeing apps. I now want my technology being delivered so that either my own team internally or my customers have apps because we're all used to opening an app. That the direction of travel is really interesting. 10 years time? Who knows? Yeah, right. Really, because it was only yesterday I saw the first bendable phone. It is impressive. Yeah,
it was deliberately bendable. Obviously.
Right. Not like the old iPhones where put it on the back pocket.
Yeah, linking all that to software as a service as well.
Right.
And I think there's a lot of opportunity there. I think we will see some major changes. But in the world of commercial business, bad things will still happen. They happen in the paper world, massively. People sort of forget that. They get worried about fraud and misbehavior by parties involved in the transaction, collusion and so on in the digital world, because it's easy to move stuff quickly. Everything happens at lightning speed. And forgetting that it's pretty easy to fraudulently prepare a bill of lading as well, actually, and nobody's going to know until it's too late. So fraud has always happened. It's always been a risk. It will always be a risk. Using the technology to create better validation and authentication of parties, I think will be a big plus going forward. I think that'll help mitigate some of those risks and promote adoption. The new world of sort of mobile technology and the use of data in that sort of really flexible way, I think will eventually, perhaps not in the too distant future, will permeate the business world as well.
Right.
But people do need to get comfortable with the fact this doesn't solve all the problems that already existed. But it doesn't make them worse. It just doesn't solve them. But maybe over time, some of these problems can be solved by better identification, validation, authentication, and so on.
You can't close the livecast with fraud.
Fraud.
So we're talking about the
let's end on fraud. That's good. Yeah. Okay, you can edit that.
Yeah. No problem.
Moving on. Yeah.
Well, gentlemen, we've reached the end of our session. Do you have any closing thoughts?
I think the only thing I would just to summarise some of the key points we made before is that the human element is important, and it can be helped by data analytics, all of the benefits of mobile technology and big data and all the rest of it. But when you're financing international trade, which is sort of what we're focused on, your source repayment occurs in the future. It doesn't occur in the past. So data on its own is not going to give you the answer. It gives you history. It tells you what has happened in the past. You still have to have an ability to interpret that against what you're seeing in front of you in terms of the management competence. So, for example, if a company has grown by 10% every year for the last 5 years, that's data. It's quite helpful to know what they tried to do. What was their aim? And if they say, actually, our aim was to do 25% a year, and we failed every time, the plan was rubbish. You have a different opinion of the competence of the management. And when they say, but don't worry, it's been 10% every year for the last 10 years, next year it's going to be 25% because this is what we're going to do. This is what we're going to do. How are you going to evaluate whether that's realistic if you don't have an intelligent conversation with a structure behind it? So it's not just a random conversation, it's actually a really solid fact-finding conversation where you're able to make an assessment, which takes skill and experience as well as process, an assessment of the competence. And you use the historic data to help you get comfortable. Either that these people know what they're talking about, they probably will do it, or actually this is pie in the sky. This is a complete work of fiction, and therefore my appetite will be adjusted accordingly. So the appetite to support companies can't just be based on historic data. It has to be based on a belief, a sort of faith in the competence of the people that are actually going to run this business. And that's underpinned by data, but it isn't the answer. Data just helps with the answer. What did you do is a good question. What were you trying to do? Is sort of a complementary question. And if you follow that thing, what would you do differently? What did you learn from that? All these are questions which are a conversation between two people who are well-informed and intelligent and respect each other. It's a relationship. And that's what gives you the confidence to say, yeah, I can support this going forward because I understand how you run this business. And I have confidence that you know what you're doing. It doesn't mean it's not going to go wrong. But sometimes when it goes wrong, that's when the partnership becomes critically important. When it goes wrong, it's that honesty and willingness to share the information and say, look, this has gone wrong. What are we going to do about it? Rather than let's not tell the bank and hope it goes away, which it never does. And when it gets really, really critical, we run out of money, then basically the game's up. We're all in trouble at that point, and the bank loses money.
On a slightly different tact, my closing thoughts and remarks would revolve around confusion that often arises for those funders, and again I include banks and non-banks, who are looking to extend their activities in the world of trade and supply chain. We meet many of them at conferences such as the ICC SCF Summit that's happening next couple of days, and talk to them offline. And they're not sure what to do because there's so much change. The pace of change feels so great. Do I sign up to every different, all the different consortiums? What should I be focusing on? Because I have limited budgets. I also have limits in terms of time and resource. And I think my closing remark is the answer is actually with your customers. And before you worry about the technology and what you should or should not be doing, you go back to your customers and you go back to the different customer segments that you are serving and wish to serve, and you really drill down and gain insight into what their needs are, and then take those needs and then develop whether it's the proposition or the platforms or the technology solution to suit the needs of the customers. That should be the way of maybe solving your confusion.
Great. Thank you both so much for your time. If you want to learn more about what John and Lionel have to say on supply chain finance, the ICC Academy is offering an advanced SCF course co-authored by our two guests. As a reminder, we will be hosting live broadcasts every month, so if you're listening, remember to sign up on our website for free and subscribe to our YouTube channel. And ladies and gentlemen, this has been another episode of the ICC Livecast. See you next time.